Okay. So now, so first of all, let me start with the chapter on fire insurance claims. Okay. This chapter has got two parts to it. One, you got to calculate the claim for loss of inventory, or we say loss of stock and trade. Okay, that's the inventory. And then the second type is you have something called the loss of profit policy. Now, how can you lose your profit? Okay, I mean, you're going to see how you can lose your profit. That we say something called an opportunity cost. Okay. And first of all, you're going to start with how to ascertain, how do you decide on how much to claim from the insurance company for your stock that has been destroyed, or that has been consumed, or that's been eaten away by fire. Okay. So if there is a fire accident, I want to know, so how much worth of inventory, okay, was destroyed by that accident, so that I can decide on the amount I should claim from the insurance company. Now the problem is that, I may not have the stock figure readily available on the date of fire accident. Now for that purpose, I got to use some approach to ascertain the inventory, or say a stock and trade on the date of the fire accident. Now how do you ascertain that? Okay. First of all, you got to understand how to go about why do you do that. Okay. So I want to ascertain, I want to calculate, or I want to find the stock, okay, on the date of the fire accident. So now you can say that's very simple. I could have taken stock the day before the fire accident, but I will not know. The fire accident doesn't happen what? It won't give a prior notice to you, right? I'm going to come, I'm going to visit your premises, okay, tomorrow evening at 12 o'clock. I got an appointment, okay, with your inventory. No. So you are supposed to ascertain the stock on the date of fire. Now how are you going to ascertain that? So the best way to understand that, let's start working through examples. So I'm going to work through some 5 or 6 examples. And if you thorough those 5, 6 examples, the concepts underlying those 5, 6 examples, you should be able to crack any example or any examination question. Our ultimate aim is to crack an examination question and not get cracked or jacked in the examination, right? So you're supposed to understand the concepts underlying these 5, 6 examples that you're going to work out, okay, this afternoon. And once you throw these 5, 6 examples, you should be able to crack any examination question, okay, on your own. And that is supposed to be the learning objective. So let's start with example 1. And after finish the 5, 6 examples, then we shall put down some theory, some steps, okay. And in fact, you will start telling the steps on your own. That is the way you're supposed to learn. Now we shall go ahead to the first example. You're going to take down, okay? Yes, Renuka. So you're going to take down example 1. Okay, we're going to work on some 5, 6 examples. And this is under the heading what? In fire insurance claims. And there are 2 topics. The first topic is what? It is loss of stock. Just write down the heading. The chapter head is fire insurance claims. And under that, the chapter head is fire insurance claims. And under that, okay, topic number 1 is what? Loss of stock. Okay? Yes, Renuka. Just take down, no? Yeah. Okay, so you have the question, right? So it's given the data for 2 years, if you notice. Okay. So it's given the data for the year 1994 and the year 1995. You know what happens? People have a wrong notion that if I say 2014 and 2015, it becomes a very new problem. If I say 94 and 95, they think, oh, it's an olden day problem. No. The truth is, the concepts do not change. I don't know how many of you know this. There's something called Accounting Standards Framework. You know that? All the accounting standards, okay, are built, or you can say constructed on the foundation of accounts, which is also known as what? Accounting Standards Framework. You all know that? Where they say that there are 5 elements of any financial statement. What are the 5 elements of any financial? One, you got what? The income. Number 2, expense. Number 3, assets. Number 4, your liabilities. Number 5 is equity. You know that? Now, once you know these are 5, you know the definition of how to define, how do you describe these 5 items. You know the definition, okay? Then nobody can shake your foundation. People have a doubt, should I treat a profit and loss account, debit balance given on the asset side of the balance sheet in the olden day format? Is that an asset? It cannot be an asset. Now, for that, you're supposed to know the definition of an asset. 5 elements like that. Okay, you're supposed to know the concepts really well to tackle any example. So it doesn't matter whether the year is 94, 95, or say 2014 or 2015, or I say 2074, 2075, or futuristic. So it's of no relevance at all. So now let's focus on this whatever something I want to work out are past CA examination questions. Okay. Now this example, they are given the data for the year 1994 and 1995. So now you should tell me in which year there was an accident. In the year 1995. When was the accident? On 1st April 1995. What is 1st April known for? 1st April. Come on, fool me. What is 1st April? April Fool. Fool's Day. Mark Twain, very popular writer and author. What he said? So that is a day on which we all remember what we are the other 364 days. It's a day of remembrance. So on 1st April 1995, there was a fire accident. Okay. And the storekeeper comes and tell you, sir, there's a fire accident on 1st April. So today, sir. Don't fool me. Come on. Okay. No, sir. Nijama fire accident, sir. You thought initially, sir, okay, he's playing the fool. He's not. Okay. On 1st April 1995, there was a fire accident. Agreed. So now let us say you want to claim, okay, money from the insurance company. So you go to the insurance company. You say, I want a claim. You know what they'll ask? They'll ask how much you lost. So that I don't know, sir. Okay. Then they'll say, forget it, you'll not get the money. Now, first of all, you got to tell me how much worth of goods were lost in the accident for me to compensate. You get it? So, for me to make good the loss, you should tell me how much you lost. I cannot compensate any amount, some X amount. Now, how do you ascertain the stock as on 1st April 95? That is a problem you have. And remember, whenever there is an example, an examination question, it's given that there is a fire accident in the premises of Mr. Garib Das, then you should what? Think you are பேரை மாத்தணும் சரியில்லை கரீப் என்ன அர்த்தம் புவர் ஓகே என்ன சொல்லுவாரு ஜோசியரு பேரை மாத்துங்க சார் எல்லாம் சரியா போயிடும் அதெல்லாம் சரியா போவாது listen now what happens is first of all I got to let's say you are Garib Das. Now how to ascertain the closing stock on the date of fire? For that I got to find what was the cost of goods that was available in that year, that is between 1st Jan 95 and 1st April 95, the cost of goods available minus the cost of goods what? Sold will give what? Cost of goods unsold. A simple logic. We'll take an example. Oh, let us say you have an opening stock of rupees 10,000. Okay, 10,000 rupees opening stock you have. Let us say you're going to buy another rupees 1 lakh worth of goods in that period. So adding both, how much you have? You know, you have rupees 1 lakh and 10,000 worth of goods. Okay. You know what is that cost of goods available for sale? Let us say of this 1,10,000 you sold goods costing rupees say 90,000. So what is the balance left? What is 20,000 goods? Exactly. So these are goods unsold. You know that should have been a stock on the date of fire. It's like that. So, but that can be done even by preparing what? A trading account. You know, I can place the opening stock 10,000, purchases 1 lakh, and sales on the credit side, and then GP, okay, 2 gross profit, and closing stock balancing figure. You can have it. The same impact. No, you know that sales minus GP gives you what? You know, from the sales, I remove the gross profit, I get what? Cost of goods sold. Simple. Now from the goods sold, that is selling price, remove the profit, you get what? Cost price. You get it? Now, but how to find the GP and how to find the cost of goods sold? For that, I need the rate of GP on my sales. How do you find that? You know, now you should know that is the reason for which they're given the data for which year? 1994. You know, it goes this way. Now, first of all, you're supposed to construct. You know, first of all, you're going to construct a trading account for the year 1994. You know, by preparing a trading account for the year 1994, you can ascertain the amount of gross profit and also calculate the rate of GP. Now, you check this, okay? Now, so it's very simple, sir. We all know how to make a trading account. Yes. We all know how to construct a trading account. So now tell me, when you're going to prepare the trading account for the year 1994, now what are the numbers I consider? Number 1, opening stock. Okay, wait. Now there is a small problem regarding the opening stock amount. You know, the opening stock amount is given as rupees 2,88,000 is given. Okay, for the year 1994. Okay, the opening stock is 2,88,000 given. And it is also given, okay, that the practice of this person, who is that? Mr. Garib Das, was to value the opening stock or value stock at cost less 10%. Wait. That means, suppose a cost price is say rupees 100, 10% on that how much? Rupees 10 less. So what is 100 minus 10? 90. That means what? That means a goods costing rupees 100, goods costing rupees 100 are valued at rupees 90. And you ask him, why did he value that way? He said, that's my practice. I smoke. Why do you smoke? I smoke. That's it. There's no reason. It's like that. You can value the goods below cost price because what is the rule as per accounting standard 2? You are supposed to value the inventory either at cost or NRV. That is a net realizable value, whichever is less. That is what given in accounting standard 2 on valuation of inventories. To be very precise, you can say it's paragraph number 5 of accounting standard 2. Okay, that's like your section number. It's paragraph 5 of AS2 says that. Fine. But have they given that because NRV is lower, is valued that way? No. It is just his practice. And that is not the right practice. Because it is definitely, you can say it is non-GAAP. What does non-GAAP means? It is not what? In line with the generally accepted accounting principles. That's a gap. Okay. There's a gap between what he has done and what is given in GAAP. The gap is what? There's a difference. The other gap is what? GAAP. Okay. So now the point to note is, listen. Now you can say that 2,88,000 represents what? Represents a 90. Because valued at 90. But what is the cost? It is 2,88,000 into 100 by 90. How much? Is 3,20,000 is your opening stock. Majority what happens in the examination, what the students will do is, okay, they'll be so tensed, okay, in the examination hall, being the first examination after a long time, okay, because you come out of CPT, maybe you would have played Inky Pinky Ponky and somehow got through the examination, okay, and by God's grace, fine. So now what happens? A descriptive. Being the first examination, you should be what? Tensed. If you are a normal human being. Okay. No, I'm not tensed. That means something wrong with you. So you should be tensed. Now the point is, what they will do is, they will take 10% on 2,80,000 and add it. So I'm not joking. See, there are people who do it, but don't do that because, what is given? The goods are valued at 10% below what? Cost price. But 2,88,000 is not the cost price. Suppose a cost price is say 100. We don't know that is, say assume 100. 10% below means what? 10% 100 rupees 10 less. What is the balance? 90. That means rupees 2,88,000 represents what? 90. What is for 100? And you get rupees 3,20,000 as your opening. Now wait. So, two opening stock is 3,20,000 entered. Then what is the next item entered? Two purchases for the year 1994. So, two purchases. The amount as given. How much? Rupees 18 lakh in? Very good. And then what is the next expenditure? Two? Yeah, wages. How much? Okay. Now what happens on the credit side? Enter what? Sales. So sales, what is the sales for that year? Rupees 23 lakh in? Okay, that is entered. And then wait. Now what happens? There is a loss in the year 94 also. So there is a loss of inventory in the year 1994. It's given on December 21st. On 21st of December, he lost rupees how much? 1 lakh worth of goods. Whenever there is a loss of stock, we consider that to be what? The two in a fire accident is an abnormal loss. You shouldn't say, I expected. I expected India to horribly fail in the series. India versus Australia. So it is an abnormal, unexpected. You shouldn't say expected. Maybe a loss by fire in a factory in Sivakasi, where they're going to manufacture what? Crackers. No, that's something normal. Yeah, it happens. It is not an extraordinary event. Okay. So here, remember, abnormal loss. You lost rupees 1 lakh worth of goods. Now, what is the entry for loss of inventory? Whenever the goods are lost. Now tell me, on the debit side, what is the purchases entered? 2 purchases, 18 lakh. Of that what? I can say, of that amount, I can say rupees 1 lakh worth of goods are not available for sale going forward. Why? The goods are destroyed. Now, how do you remove that 1 lakh from the account? Very simple. You ask a small kid, what do I do? Very simple. To say what? From 18 lakh 76,000 rupees, 1 lakh should be removed. But we accountants will say, no, my child. Since a purchase account has been debited, what you should do? So the entry goes this way. Abnormal loss account debits. Abnormal loss account debit. Why? You debit all expense and losses. Abnormal loss account debits. Okay, rupees 1 lakh. And 2, either credit purchase accounts. So you can directly subtract from purchases, or you can credit which account? The trading account. It's all the same. The financial impact is I want to remove 1 lakh from the goods, because those goods are not meant for sale. And I can't say it's available in my godown because it's already destroyed. So therefore, abnormal loss account debit to trading. What happens? The students, they are more interested in getting the answer rather than understanding what is a flow of entry. So now, it is abnormal loss account debits. I repeat myself, abnormal loss account debits, 2 purchases. That entry can be passed. If you do that, you have to reduce 1 lakh from purchases. Or what is done out here? Abnormal loss account debits, 2 trading accounts. So by abnormal loss, 1 lakh. In other words, I removed what? 1 lakh goods from my trading because not meant for sale. Okay, removed. And then finally enter the closing stock figure. By closing stock. Again, the closing stock amount is given as rupees 4 lakh and 84,000. This person, Garib Das, okay, what has he done? Now, suddenly there is a change in practice. Now, he says that, let me value inventory at cost. See, he's gone the other side. He should be a monkey, right? He jumped from 90 to what? Say 110. Why 110? Suppose the cost price is say 100. The goods are what? Valued at 110. 10% above cost. That means, suppose the cost price is say 100. On that 10%, how much? Rupees 10 extra plus. So 110. So now you can say rupees 4 lakh and 84,000 represents what? Represents 110. But I want to know what is the cost. So what is for 100? I can never value the inventory above what? Cost price. How can I ever do that? Okay. So that means this person does not know anything about accounting standard 2. Okay. You're supposed to take a class for it, right? On AS2, you're supposed to tell him that you're not supposed to value inventory above cost. It's either cost or NRV, lower of the 2. Okay. Whichever is less. Fine. So now 4,84,000 into 100 by 110. Because this represents 110. What is for 100? 4,40,000. Suppose you want to cross check. So I don't trust you. Okay. 4,40,000 on that 10%. How much? 44,000 extra. You know, 4,84,000. You get it? So we enter the closing stop as well. Now the balancing figure represents what? The gross profit. And you get a GP of 4,64,000. I got that. Then what happens after this trading accounts? After finding out the GP, I want to know the rate of GP. Every child, okay. I know whether should I say that, okay. Every child, okay, every kid knows that. What is GP ratio? It's a GP by sales. What is it called? It's called the gross profit margin. Remember, whenever you express a profit as a percentage of sales, what is it called? Gross profit margin or net profit margin or operating profit margin by sales. Now, suppose I express a gross profit on cost. What is it called? Come on, what is it called? What is it called? Guess here. Kasa Panama. What is that? Try. Give something, some answer. Now, whenever the gross profit is expressed as a what? Percentage of cost of goods sold. What is it called? If a GP by cost of goods sold into 100, what is it called? Now, GP by sales is called what? Margin. Okay, GP margin. If a GP by cost, what is it called? It's called the markup. We say it's a markup percentage. Why markup? Cost plus profit equals what? Selling price or sales. It's called the markup percentage. Now, in this example, you can check your trading account for the year 1994. You check. What is the opening stock you entered? 3,20,000. And then what is the purchases? Please enter these numbers in your calculator. So 3,20,000. Just calculator. Just use a calculator. That will do. 3,20,000 plus 18 lakh, 76,000. Plus what is the wages amount? Rupees, how much? 2 lakh. Add up all the three. Add up all the three. How much? What is that? That is supposed to be the cost of goods available for sale. So that is supposed to be the cost of goods available for sale. Wait. Of the cost of goods available to be sold, okay. Now, how much is not sold? Minus 1 lakh, what is destroyed? And also minus 4,40,000, what is unsold? You minus 1 lakh and minus 4,40,000. What is the balance you get? 18 lakh and what is this? You sold the goods costing, this is the cost of goods sold. No, we say CGS or people say COGS. This is supposed to be a cost of goods sold. You sold the rupees 18 lakh, how much? Worth of goods for how much? Sold it for 23 lakh and now take the difference. The difference is 4 lakh and what is that? That's a GP. That's a way to understand your trading account. People think a GP is a balancing figure. No, you're comparing what? Cost of goods sold against what? Sales. What is the concept you're applying? What is the concept being applied? Exactly. Hats off. And that's a way to go. That's a matching concept. You're matching what? Your cost of goods sold against sales. That's a matching concept. And the best example is a trading account. So you can say rupees 18 lakh, how much? You got 18 lakh and 50? 6,000 worth of goods are sold for how much? 23 lakh 20. So I get my GP. Now I want to find the rate of GP, means always what? On sales it computes. So you got to calculate the rate of GP. So what is the rate of GP? It is 4 lakh and 64,000 divided by 23 lakh and 20,000 into 100. How much you get? 20% is the rate of GP. Okay. You know, we are done with the first step. So we prepared a trading account for the year 1994 and ascertained the rate of GP.